So when we price things in dollars, it's make pretend. But if you price it in gold, you'll see that most commodities, or baskets of commodities, are approximately 25% where they should be in terms of long-term value. Only 25%. Wow. So if you and energy is about the same. I mean, oil is about the same. So these commodities have become very, very underpriced, I would say, because of the distortion of accounting in fiat currencies, and particularly fiat dollars. That's really why it has gone adrift, if you like, from reality. So if you looked at that the other way around, you could say that, well, in real terms, given that the purchasing power of gold is fairly level throughout, long periods of time, what you could say is that the value of these commodities should rise roughly 300%. It's something we've never really seen before. The amazing thing, Andy, is that the speculators are not in there. I mean, if you look at open interest on COMEX, in silver, we've been hitting over 20-year lows in open interest. Is that a contract full of speculators? No, it's not. Gold, similarly, I mean, with gold's open interest at around about 400,000 ounces, that again shows, a lack of speculative interest. I mean, there's lots and lots of talk about speculative interest and how, the retail industry sort of bought it and they're being shaken out and so on. Actually, obviously there's no pure argument in this, but the evidence from the Far East, which is really where the retail demand is that on this drop, the retail interest is being maintained. I mean, they're saying, whoopee, it's cheaper to buy gold, go and buy some, or silver.
Wow.
What it is I think the best way to explain it is that the paper market has now become completely divorced from the underlying price and value, if you like, of bullion. And since nobody is really in there challenging it, you can make what you like. You can call silver 120, 60, I don't know, anything you like.
Because the paper markets are entirely rigged, massive financial institutions have been caught completely off guard. While major banks publicly predict much higher gold prices, Macleod reveals a shocking secret. Their trillion-dollar managed portfolios own practically zero physical metal.
Nobody in there actually saying, I've got to buy this. I mean, they've marked it down, it's so cheap and all the rest of it. So that's the basic answer. I think there is another answer too, and that is that we're coming up to the first quarter, March 31st, and the bullion banks have a problem. They can see that financial markets are getting more and more risky, and gold and silver less so. But they don't have any. And not only that, but if you think about the big banks in America, they've all been saying, for very good reason, we expect gold to go to $6,000, $6,500, whatever. You've even got, I think it was Morgan Stanley saying, it's no longer 60-40, it's 60-20-20.
Right.
But what people don't realize is that these banks in their managed accounts, and it's not unusual to see a major American bank managing $1 trillion of other people's money, they haven't got any gold in there at all, or none to speak of. They are embarrassed by this. They're short, and they can see that they themselves are going to have to buy this, but there's none around. So that means that the outlook is for a massive continuing squeeze, basically, as particularly the silver contract, the silver futures contract, becomes not good for purpose. I mean, do you really want to be market making in a silver contract when you can't get the underlying physical?
Can't get delivery, yeah.
Yeah. So I mean, the problem first hit London.
These massive institutions desperately need to acquire physical bullion, but the global vaults are nearly empty. To solve this crisis, the banks are intentionally crashing the paper price to trigger margin calls and panic sell retail investors out of their physical positions.
But you can see why it is that they basically want to bash it, because they want to shake out those few people, maybe even persuade a few hedge funds to go short, because, you can put forward an argument. You can say, we got inflation down the road, so we're not going to get a reduction in interest rates. Interest rates could well go up. That makes it more expensive to hold gold and silver, so they should go down. This is the Keynesian argument, in effect, the macroeconomic argument, which we had thrown at us for years and years and years, in complete defiance of actually what happens. How this shortage developed and why it is still with us. I mean, there's still backwardations in silver, despite the fact the price has fallen from paper 120 down to a paper 60 odd, 60, what did it hit, 61, 62 yesterday. Oh, and incidentally, one thing that's interesting is on the sell-off yesterday, if you look at the volume figures on COMEX, they're through the roof. In other words, this is a classic technical bottom where, you get that sort of you got a mixture of people sort of throwing up in fear and buyers getting in there and buying, that is the classic sell-off climax. We've seen that in the technical sense. Now, given that what we're really talking about is trying to get prices down so that the options expire worthless, and there are quite a lot of options expiring worthless on this at a lower price, then you can see there's huge incentive for the market makers, the bullion bank traders, whatever, to try and suppress it. So that's all we're seeing, really. I mean, what a wonderful opportunity for stackers. By my analysis, commodity prices were very, very cheap in real terms. Now, by real terms, I mean measured in gold, because that is real money. The rest of it's fiat rubbish, okay? So when we price things in dollars, it's make pretend. But if you price it in gold, you'll see that most commodities, or baskets of commodities, are approximately 25% where they should be in terms of long-term value. Only 25%. Wow. So if you and energy is about the same. I mean, oil is about the same. So these commodities have become very, very underpriced, I would say, because of the distortion of accounting in fiat currencies, and particularly fiat dollars. That's really why it has gone adrift, if you like, from reality. So if you looked at that the other way around, you could say that, well, in real terms, given that the purchasing power of gold is fairly level throughout, long periods of time, what you could say is that the value of these commodities should rise roughly 300% to get back to normal. And that doesn't assume any overshoot. Now, of course, we don't know that it'll get back to normal quite that way. But if you put on top of that a depreciating purchasing power for the currencies, then your base case has got to be at least 300% increase. And depending how you feel about the dollar, it could be significantly more. So what this war has done, actually, is acted as a catalyst to hurry up something that was already in the works. And I think that's the key point, because, you've got people running around saying, well, it's, gold, it's not gold, oil has gone up to $100, might go to 120, might go to 150, whatever. I mean, they miss this point. Do not be surprised if by the end of this year you see the oil price far, far higher. I mean, depending what happens to the dollar. I think that is actually an extremely important point, because what we're going to see is we are going to see widespread inflation at the consumer price level because of this commodity effect. And it's not just oil either. The Middle East, because it cracks oil down into petrochemicals and all the rest of it, It's a big source of fertilizers, big source of urea, big source of sulfur, which goes into the, sort of potassium thingies, sort of potassium fertilizers and all the rest of it.
Yeah.
And, things like helium, which are vital for making chips, and also apparently vital for all sorts of things you'd never think it was vital for. I mean, someone said that fiber optic cables can't exist without helium. Well, it was new to me, but it would. I mean, someone else made the point, and this was a professor who specialized in petrochemicals and all the rest of it. He said that he tells his students, I think it was in the University of London, or one of those, that there are 45,000 consumer products which depend on the oil price, or derivatives of oil or whatever. I mean, so what this means is that the inflation rate, which nobody was really looking for, is going to be through the roof later on this year. Okay, what does that do to bond yields? Well, they could be through the roof as well. So that's what's going on. And I can just imagine that on Monday morning at 6 o'clock in the morning, they were shaking Trump awake, saying, Taco, for God's sake, Taco. Besant saying, look, this is going to screw up my debt management program.
Right.
Because all these bonds, they suddenly saw the whole thing. There's no way you should get any cuts in interest rates. Having said that, Powell leaves in May. And if Trump has his way, he would have interest rates at zero. And indeed, forcing interest rates down could be about his only salvation ahead of the midterms, because everything else is going horribly wrong for him. Mm-hmm. The problem that Powell and his successor really has is that when you get rising bond yields, and let's say the 10-year goes through 5%, that's going to crash the equity market. Mm-hmm. You crash the equity market, then according to the Fed's playbook, confidence in the underlying economy takes a very, very bad knock.
Yeah.
You need to have a good stock market to have confidence in the economy. Mm-hmm. So what do? He's got a choice. Either he protects the dollar by raising interest rates and having to rescue banks, seeing zombie companies who loaded up on very, very cheap debt during the years in the run-up to the COVID crisis and through 2020, mm-hmm. who are now, having sort of maybe borrowed 2, 3, 4, 5-year money at less than 1%, if you were a sort of prime borrower, you're now looking at refinancing at, could it be 5 or 6%? Basically, if you're overloaded with debt and you've leveraged up your earnings, this is a disaster. And this is, of course, where the private equity industry is really hung out to dry by all this. And also, real estate and all the rest of it.
Yeah.
So what does he do? Does he just stand back and protect the dollar and say that, we've got to protect the dollar, that's more important? Or does he do the opposite and take whatever action is necessary, along with the US Treasury, in order to rescue the economy? Well, mm-hmm. I think the answer is the latter. That's the mandate. That's his mandate. And, to hell with the inflationary consequences. In other words, you're going to find that the value of credit, or the other side of credit, debt, is going to get wiped out. It either gets wiped out by businesses and banks going bust, or it gets wiped out by the, if you like, the currency in which you value this debt being depreciated right down to whatever is necessary. And that's going to be the choice. And I'm absolutely clear in my own mind, it is the political imperative which will win. And that is, sacrifice the dollar, don't sacrifice businesses.